Assalamualaikum warahmatullahi wabarakatuh. My name is Anis Fadilah binti Amiruddin. My matric number is 264474. So today I will present the question number 4. For the question number 4, board preliminary review decided that company should disclose all the information regarding the synergies and also to specify the liabilities arising from financing activities and defined benefit pension. Liabilities are the major classes of liabilities. So for the first part, we agree with board's preliminary view. This is because all this information regarding the synergy is necessary to be disclosed in order to allow the financial statement users to assess the nature and financial impact of a business combination that happens. Synergy can be defined as financial inflows that are expected to arise or benefit the company after the company combine the business through the merge and acquisition. From the investor's perspective, the nature, timing, and the amount of the expected synergies are very crucial aspects for them to understand the company's management better. The board also required the company to disclose the estimated amount and estimated cost to achieve the synergy. However, the auditability of synergy is very difficult to quantify. So the board decided that the company are expected to make estimation of the synergy. They could provide a range of estimation for the synergies and costs to achieve the synergies. If the company did not have the clear view on the purpose of the acquisition, this will lead to failure in merging companies. This view is given by Protiviti. Protiviti is a global consulting firm that provides consultation in internet audit, risk and compliance, and etc. According to them, the best time to merge the business is when the needs meet the opportunity. One of the failures in acquisition is due to the failure to focus on the value creation in the early process of synergies. So in order to avoid this from happen, the company need to disclose this information regarding the synergy so that the investors can assess the effectiveness of the acquisition. For the second part, yes, we also agree to specify liabilities arising from financing activities and define benefit pension liabilities are major classes of liabilities and should be disclosed separately. This is because some of investors regard them as a part of total capital employed in the transaction by the acquirer as mentioned in paragraph 2.46b. According to Severinson, defined benefit pension can be one of the company's main liabilities and investors, management and users are frequently pay attention to it. Financing activities are activities that alter the equity, capital and borrowing structure of the entity according to IAS 7. Financial activities will affect long-term liabilities and equity. It is used to fund company operation or expansion since both of them are important aspects of balance sheet. It should be classified as major classes of liability. Company also must disclose the amount of this liability acquired as a part of the acquired business separately if the information is material. This classification can be supported by the statement from FRC. The valuation of pension obligation is very complex and requires significant judgment and assumption which carry the risk of material misstatement. So the defined benefit pension should be classified as major classes of liabilities and be disclosed separately. For the liabilities arises from financing activities, the investors are looking for a net debt reconciliation, but since it is prepared using non-GAAP measures, the auditor will not allow it to be included in the financial statement. It just disclosed in the annual report. Since it will reflect the poorly specified disclosure requirements that will tarnish the disclosure objective, so the liabilities arises from the financing activities should be specified as major classes of liabilities that needed to be disclosed separately as a part of acquired business if the amount is material. By doing this, it will be helpful and useful for the investors and it is easy for the company to implement it. All these items are already available to companies since these items are required to be recognized and measured at the date of acquisition. So that's all from me. I will pass the floor to the next presenter.
Hi, my name is Alia Aimi binti Nazaruddin. My matric number is 264476. So I'm going to present my answer for question 10A. So this question is about the proposals to remove the restriction in IAS 36 that prohibits companies from including some cash flows in estimating value in use, which is about the cash flows arising from a future uncommitted restructuring or from improving or enhancing the asset's performance. The next proposal is about to allow companies to use post-tax cash flows and post-tax discount rates in estimating value in use. Should the IASB develop such proposals? My answer is yes. The board should develop such proposal because as removing the restriction can improve companies' operation to estimate value in use. They can reduce the cost and complexity as they need to adjust their financial budgets if they exclude such cash flows. It is hard for the management to recognize which subsequent cash flows need to be removed. Furthermore, it can also reduce the impairment test error because of cash flows projection prepared, observed, or used internally for decision making instead of using the forecast generated only for external reporting. European Financial Reporting Advisory Group (EFRAG) support the IASB's proposal to remove the restriction too. They supported the proposal as it would take into consideration management's view of the business and simplify the impairment test. This proposal can allow companies to use directly their budgets and forecasts, which are likely included the impact of future restructuring without making artificial adjustments to remove them. To some level of safeguard against all types of plans being reflected in the projection, it is only required that only management approved future restructuring could be included in the projections. Next, we move to the second proposal. I agree for the proposal to allow companies to use post-tax cash flows and post-tax discount rates in estimating value in use instead of using pre-tax discount rates. According to preparers, investor valuation experts, and members of the boards, consultative groups, the rate of the pre-tax discount rate is not observable and is not used to valuation purpose. It is tough to understand and does not give useful information. Furthermore, investors are more intrigued in after-tax rather than pre-tax returns. For your information, post-tax measure is considered in current value of an asset. EFRAG considers that this proposal would reduce the cost of the goodwill impairment test, provide more useful information, and make sure the test more understandable. It will be more consistent with other IFRS standards too. The result of using discounting post-tax cash flows at a post-tax discount rate and discounting pre-tax cash flows at a pre-tax discount rate is actually the same, but make sure the pre-tax discount rate is the post-tax discount rate adjusted to review the specific and timing of future tax cash flows. So this is the example of calculation using the pre-tax and also the post-tax. You can tell that from the original pre-tax calculation, the result is lower than the post-tax calculation. However, you can produce the same answer for the pre-tax with the post-tax, but you have to make an appropriate adjustment, and this require an additional work and will make the calculation be more complicated. That's why I support on ISB proposal to use the post-tax calculation or measure instead of the pre-tax. So that is all from me. I will pass to the next presenter to answer for the question 10B.
Assalamualaikum and a very good day. My name is Nur Amiratu Akila binti Nur Razmi, metric number 261052. Today I will present question 10B. The questions are, should the board propose requiring discipline in addition to the discipline already required by IAS 36 in estimating the cash flow that are subject of this question? Why or why not? If so, please describe how this should be done and state whether this should apply to all cash flow included in estimate of value in use and why. In preparing an estimate of cash flow for the board proposing requiring discipline, it is necessary to set a probability threshold in ensuring which cash flow will be used and included as a more likely than not threshold. It requires additional qualitative disclosure. It is about the measurement uncertainty related to the estimate of the amount, timing, and unpredictability of this particular cash flow. In the view of board during the preliminary review is that it does not require to place a probability threshold or require additional qualitative disclosure. This is because they argue that IAS 36 has required companies to use an appropriate and supportable assumption as discussed in the management over optimism section in the discussion paper. The next reason is that in paragraph 134D and 134F of IAS 36, it showed that it requires company to disclose information about assumption on which management used its estimate of the recoverable amount. In the view of board, the requirement stated in the reason paragraph, it is expected to provide adequate discipline over the cash flow. Is the proposal could eliminate an inconsistency in the sense that it will capture within the value in use the cash flow that will arise from any existing potential to restructure or enhance an existing asset rather than ignoring this potential when determining fair value. If a company estimates that the cash flow are too optimistic, the overly optimistic will be handled more effectively by auditors or regulators. It should be addressed actively regarding this issue and consider what would be necessary to develop a further guidance on when to include restructuring cash flow in the calculation. For example, it should be taken into consideration to allow only future restructuring that has been approved by the management can be included once. Lastly, according to a European Financial Report Advisory Group known as BKAR3053, they support the IAS proposal for the removal of restriction of IAS 36 and to remove the requirement used in pre-tax input and discount rates. We can examine that Australian Accounting Standard Board known as AASB also agree with the proposal that has been proposed by IASB. It should be applied to all cash flow included of estimate of value in use because we support and believe that the proposal apply not only to cash generating unit containing goodwill, but to all asset and cash generating unit within the scope of IAS 36. That's all from me. Thank you.
Assalamualaikum, my name is Nur Ain Farisha, my metric number is 261049 and I will continue the presentation to question 11a. Should the board develop any of the simplification summarized in paragraph 4.55? If so, which simplification and why? If not, why not? Okay, I will start with the simplification summarized in paragraph 4.55 that the board should develop. The first one is allowing companies to test goodwill at the entity level or at the level of reportable segment, rather than requiring companies to allocate goodwill to group of cash generating units (CGU) that represent the lowest level at which the goodwill is monitored for internal management purposes. Many stakeholders say in allocating goodwill to CGU is one of the main challenges in impairment tests. IAS 36 and IFRS 8 stated about impairment of asset. The test of impairment loss on goodwill must be done at level not larger than the operating segment. IFRS 8 made things complicated where operating segments are allowed to aggregate into higher level of reportable segment if they meet some criteria. Hence, to make it more simpler and avoid misunderstanding, the CGU should be clarified to test to impairment loss using reportable segment rather than use the lowest level to operating segment. This is because in CGU field has become wider, like business combination is also one of the assets included in CGU. Therefore, in avoiding some cases that have occurred, where company failed to record impairment loss in several subsidiaries and investment in associates, the board should develop a simple test for impairment loss regarding the CGU issue, cash generating unit issue. Next, I move on to the simplification summarized in paragraph 4.55 that the board should not develop is adding more guidance on the differences between entity-specific inputs used in value in use and market participant use in fair value less cost of disposal. This is because in IFRS 13, the fair value measurement is standard defined fair value based on using the fair value hierarchy and exit price notation, which is the standard asked to use on using the market participation, rather than entity specific to measure the fair value less cost of disposal. The standard definition made a clear guidance to differences between the value in use for entity specific and also the value in use for market participation. Hence, adding more guidelines will not make any changes. Apart from the above matters, the next point that the board should not develop in the simplification summarized in paragraph 4.55 is mandating only one method for estimating the recoverable amount of an asset, either using the value in use or fair value loss cost of disposal, or requiring a company to select the method that reflects the way company expects to recover an asset. Before further discussion, I would like to ask you guys to see why the impairment test should be used to method. This is because the impairment test, the recoverable amount of an asset should be less than the carrying amount. If an asset of a company calculated and resulted the recoverable amount of the asset is higher than the carrying amount, the asset must not be included in the financial statement. Hence, in order to find the correct recoverable amount, company given two choices, either to use the value in use or for value less cost of disposal in calculating the impairment test. Carrying amount exceed the recoverable amount in asset, then the asset should be impaired, and the company could calculate the impairment loss. If the company required to choose only one method, the financial report will have miscalculated, and this will be bad for the company. I think that's all for me. Thank you.
Assalamualaikum and hi, my name is Nur Hawari Haliana binti Uthman, metric number 261054. So for my part, I will share with you the answer for question number 11B. So the question asks us to suggest other ways of reducing cost and complexity of performing the impairment test of goodwill without making any information less useful to the investors. In our opinion, rather than goodwill should be tested every year, it can be changed to just test it when it necessary. For example, if there is any changes that give material impact to the value of goodwill, so impairment test should be done. But if there is no changes, so no need for the company to test their goodwill. This can be applied to all companies to reduce cost and also the complexity to test the goodwill. And for private business, they are already allowed to amortize their goodwill using straight line basis up to 10 years. So they don't need to test their goodwill every year. So all companies must apply this to reduce cost and complexity of impairment test of goodwill. Our second opinion is to improve the guideline on how to perform impairment test of goodwill. So as for now, the test must be performed for a cash generating unit. So if this way can be changed, it can reduce the complexity for the company to test the goodwill, because cash generating unit is quite complex. So if this can be improved, so it can reduce the complexity and also the cost for the company to test the goodwill. I think that's all from us. Thank you.